Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our conventional tanker market update for October 2015. Well, in our video from last month, we talked about how tanker rates, which had been strong through July and August, had started to come off through August and September. And we said that that was a temporary phenomenon due to refinery maintenance and that we expected a pretty strong winter market as we go into Q4. Well, it seems like that's come a little bit early this year, and just in the last week we've seen VLCC rates go above $100,000 per day for the first time since late 2008. And that's for a few reasons. What we've seen is very strong purchasing from Asia, in particular from China, and that's as refineries come out of maintenance, they've started increasing their purchases of crude again. We've seen that crude coming from different regions around the world. We've seen a big increase in Middle East cargoes, particularly from Iraq. We've seen a very strong loading program out of Basra, but also places like Saudi Arabia where they're cutting their prices to try and price themselves into Asian markets. But we also continue to see crude moving long haul from the Atlantic, from West Africa going to Asia. And we've also seen quite a few VLCC cargoes picking up from the North Sea and going to Asia as well. And that's obviously a very long journey going around the Cape, because the V's are too big to go through the Suez Canal, so that creates a lot of ton miles on the VLCCs. And so that's what's really driven the rates towards $100,000 per day, and we think that those rates could stay pretty strong through Q4. In the mid-size ranges, the rates haven't been quite so strong, but we've still seen Suezmaxes pick up to about $40,000 per day and around $30,000 per day on the Aframax. And the reason the rates there haven't been so strong, there's sometimes a bit of a lag effect. It takes a bit of time for, as the VLCC rates come up and the VLCCs get pulled out of position, you would expect the Suezmax to come up, and I think the Suezmax rates will come up more in the next couple of months. We've also seen in the Atlantic basin on the mid-sized ships that activity hasn't been quite so strong as it has been on the VLCCs going to Asia, and that's partly because European refining margins have been a little bit weak. Margins in Europe at the moment are probably the lowest in the past year. And that's because there's been such a big increase in product stocks in Northwest Europe that it's depressed those refining margins and perhaps reduced some of the crude buying into Europe, which would normally be done on Aframaxes and Suezmaxes. But we think that that should recover as we go into deeper into Q4 and as demand starts to rise towards winter. We're also seeing a pretty strong Russian loading schedule for the next month or so, and so that should create a lot of cargoes in the Black Sea and Mediterranean. And as we go further into Q4, I think you'll see the weather becoming a bigger factor. At the moment, it's not really a factor in places like the Bosphorus Straits or in the Baltic, but I think as we go through October into November, we will start to see those shorter daylight hours, more fog, more bad weather, and that will add to some of the vessel delays. So we are still expecting a very strong winter market through Q4 and Q1. And in general, I think we expect the tanker market to stay strong through the next 6, possibly to 12 months. As we've said in previous videos, 2016 looks pretty good to start with. We still have very low oil prices, very high oil production, and pretty minimal fleet growth on the crude side until we get to the latter part of 2016. I think we still think that the risks on the crude side do start to grow a bit into the second half of next year, and that's on the back of some fleet growth. And also I think over time we do expect crude oil prices to rebalance a little bit. We're already now starting to see that US crude production is starting to come off because of low oil prices. And the expectation next year is that non-OPEC production will start to get trimmed a little bit. So with demand rising and non-OPEC production coming down, that means there's less spare production capacity in the world, and that could just give a bit of a lift to oil prices, which could reduce some of the positive impact we've had this year on refining margins and stockpiling. So that's our update on the conventional tanker market, and we'll talk to you again next month.